Dear students, welcome to the next video lesson. And we are going through the chapter Sources of Business Finance. And in this video lesson, we are going to learn about the concept debenture and public deposit. Debenture and public deposit. You know very well what is the different sources of business finance. So debenture is also another form of long-term source of business finance. Actually, the debenture is given to the company by creditors. So the debenture holder is known as creditor, and the debenture is a document. It is a financial instrument issued by the company for raising additional finance, debt finance. A debenture may be defined as an instrument in writing issued by a company under its seal and acknowledging a debt. That is why it is known as debt instrument. A debt for a named sum of money and giving an undertaking to repay that sum on or after a fixed future date, and meanwhile to pay interest thereon at a certain rate per annum at stated intervals. So, a debenture is an instrument issued by the company for a certain sum of money, and the amount will be repaid after a particular period of time. And the debenture holder, that document holder, will get certain sum of amount as interest. So the return for debenture holder is interest. The debenture capital is divided into a number of equal parts called debentures. Debenture holders get a fixed rate of interest at fixed intervals. It will be stated in the agreement. So remember, it is a debt instrument issued by the company. And the kinds of debentures include, first one is simple or naked or unsecured debentures. Unsecured or naked or simple debenture, they do not have any security given by the company in the form of asset. And the secured or mortgage debentures, they have security by the company, maybe an asset, and they will get fixed rate of interest. Redeemable debenture, it will be repaid after the specified period of time or the maturity period of time. So, simple, secured, redeemable debenture. Then bearer debenture, debenture issued without the name of the owner is bearer debenture. It is freely transferable. Anyone can transfer from one person to another. Then a registered debenture, the name and address of the registered debenture will be registered as per the Companies Act. And convertible debenture, that can be converted into shares or any other form of debenture. So these are the different types of debentures. Remember the names and what is the difference between each debenture. Advantages of debenture include debenture holders have no voting rights, no need to manage the company activities. Then, in case of debenture, trading on equity is possible. Already we have learned what is trading on equity. So in this case, debenture can be traded. Means the possibility of trading on equity is there. Then interest on debenture is an allowable expenditure under Income Tax Act. They will get exemption from that. Then debenture can be redeemed at any time when company has surplus fund. It can be redeemed at any time when the company have surplus fund. So these are the advantages of debentures. Certain limitations also they have. Debenture capital raising is costly. Sometimes the huge stamp duty the company have to pay for raising debenture. Then common people cannot be, they cannot buy debenture as they are of high denominations. The value, the face value of debenture will be high. So common people is they are not able to purchase the debenture. If the company expects fluctuations in profit, debenture issue is not advisable. If the profit is very low, it is not suitable to issue debenture because with the profit, the company is paying the interest. Then fixed rate of interest is a burden to the company. That is also another disadvantage. So remember the disadvantages. Then what is the concept of retained profit or plowing back of profit? It is another source of honest one. Whenever they have enough profit in the hands of the company, they can keep the amount as a reserve. That is retained earnings or plowing back of profit. Creation of reserve by companies out of their profit and using them to meet financial requirement is known as plowing back of profit or internal financing or self-financing. So the plowing back of profit have a lot of merits. Retained profit is more dependable than any other sources of financing. No need of paying more expenses to raise the fund. It is very easy to convert or to take money from their own hand. So it is more dependable. Then no need of paying dividend on reinvested profit. No need to pay the dividend to the shareholders when the company reinvests the profit. No cost involved in raising fund. That means no expense needed to raise fund in the form of retained profit. No security is also needed. Then it avoids super tax to be paid to the company. Then very economical method of financing. Then aids capital formation very easily. It makes companies financially strong. Every time investors will advise these type of methods of raising finance. And so remember all these points of raising finance, it have some limitations also. A retained profit may be misused to manipulate the value of shares. Sometimes the company will misuse when they use the retained profit, the company will misuse to manipulate the value of shares. And the company runs the risk of being converted into monopolistic organization. Sometimes it will be the organization when they will use retained profit, it will be in the form of monopolistic organization. It may result in overcapitalization. Sometimes converting or reinvesting the profit in the company will lead to overcapitalization, unnecessary amount in the capital. It may create dissatisfaction among the shareholders. All are of not same opinion, so there will be different opinion among the shareholders. And it may be used for tax evasion. Sometimes it may be used for tax evasion also. So it may be misused in different way. The retained profit reinvestment is misused in different way. Remember the points. The next source of long-term finance is medium-term finance is public deposit. Public deposit means collecting funds from the public, the common man, by paying some interest. So we can collect these type of funds for from 6 months to 36 months. So remember, public deposit is another source of raising finance given by the company or accepted by the company by paying interest. And normally 6 months duration is the minimum, and 36 months means 3 years is the maximum duration of public deposit. It has some merits. The system of public deposit is very simple, involving no legal formalities. Issuing share is it involves a lot of legal formalities, but issuing collecting money through public deposit have only limited legal formalities or no legal formalities, and it facilitates payment of higher dividend to shareholders. So every time issuing or collecting funds through public deposit helps the company to pay higher dividend to the shareholders. Then it does not create any charge on the company's asset. No need to pay security in the form of company's asset. So these are all the very important merits, and it have some demerits also. Deposit raising being inexpensive, but companies may do over trading speculative activities. Sometimes there will be lot of speculative activities related to public deposit. Then investors are deprived of benefits accruing from good securities. The investors sometimes they will never choose these type of methods. Also, if companies do not earn good profit, public deposit turned out to uneconomical. The company is not earning more profit, it will be uneconomical. Okay, thank you. Bye.